So Jeff and I have over a decade of experience investing in North American equity markets, including over $1 billion managing the exact same strategies we manage here at Alignvest. So we do have a long and successful track record managing these strategies over a number of years and different market cycles and market environments. In addition, we do have a very seasoned and experienced compliance and operations team, and we do have the ability to leverage the bench strength that exists at Alignvest Management Company.
So we're a North American equity long-short manager with a focus on Canada, and in particular the mid-cap non-resource segment of the market. Our core areas of focus are consumer, industrials, energy, and financials. We're value-oriented, fundamentally driven, bottom-up investors. So while we're mindful of the macroeconomic environment and its impact on asset prices, it plays a much bigger role in risk management for us than portfolio construction. Our overall exposure to the markets at any given point in time is really a function of how many attractive long ideas we're finding relative to our short ideas, but will generally be between 20 and 60%. We do like to keep our exposure relatively low and focus on generating returns from security selection, which we think gives us the best chance of delivering attractive risk-adjusted returns across a broad range of market conditions. So over the course of a business cycle, we're looking to deliver returns in excess of equity markets with substantially less volatility and relatively low correlation. We employ a research-intensive, fundamentally driven investment process. Ideas can come from anyone on the team, and we'll consider a wide range of sources, including quantitative screens, respected industry peers, third-party research providers, industry conferences, and other avenues. We view ourselves as owners of every business, and so we perform a fundamental analysis of the company and the industry. Our starting point is usually the company's regulatory filings and investor communication, which allows us to form a preliminary opinion of the business and a view of value. Once we've obtained that, we'll typically look to sell-side research, more with a view of assessing the market's expectations relative to our own. In addition to detailed financial statement analysis and valuation, we're also working hard to assess things like industry dynamics, the durability of any competitive advantages, the track record of capital allocation, governance, and the alignment of management with shareholders. We also try to gain additional perspective through speaking with management, as well as customers, suppliers, distributors, and even competitors. Our core long positions will generally fall into one of two categories. The first is what we call long-term compounders. These are outstanding businesses with sustainable competitive advantages and management teams that have a proven track record of allocating capital wisely and whose incentives are very well aligned with creating long-term shareholder value. These unique companies are seldom cheap, so the best opportunities are when the market either undervalues or underappreciates the durability of the competitive advantage, or they sell off in sympathy with a broad market correction. The holding period on these kinds of investments tends to be fairly long and would be measured in years and not months. The second category are what we would call special situations or value with a catalyst. These companies are typically not as unique as the companies in the first category, but are substantially mispriced or misunderstood by the market. We need to develop a differentiated view of value from the market and the confidence that we've identified catalysts that will help to unlock it. Usually the disconnect surfaces as a result of things like increased complexity, an imbalance of buyers and sellers, a lack of institutional ownership or research coverage, and in many cases we actually act as the catalyst. We'll work with management teams and boards of directors to help them surface value and or do a better job of articulating the story and the risks and opportunities facing the company to the market. Our short book is designed both to mitigate risk and also to generate alpha through a cycle. We're looking for businesses with fundamental attributes that would essentially be the opposite of what we're looking for on the long side of the portfolio. So you can imagine companies with secular headwinds, undifferentiated products, poor competitive positioning, and dispassionate management teams with a poor track record of capital allocation. On both our long and short investments, we're ideally looking for an asymmetric return profile where the potential upside is dramatically larger than the potential downside, and the estimated annualized return over the expected holding period is above a certain minimum threshold. To the extent we can construct a portfolio of those asymmetric return profiles, we think we should be able to deliver on our goal of generating strong, absolute, risk-adjusted returns with low volatility and minimal correlation to the equity markets. Reno and I are significant owners in the business and have substantially our entire liquid net worth invested in the funds, which helps ensure a keen focus on managing risk both within the portfolios and across the organization. At the individual position level, one of the things that we think provides the best defense against risk is really understanding what it is that you own. So while we're portfolio managers, we consider ourselves analysts first. Every name in the portfolio has been extensively researched by either one or both of us. There is no formal investment committee that meets once a week and makes decisions based on a 30-minute pitch by an analyst. We're intimately involved in every idea, from idea generation all the way through to the ultimate exit. We stick to our well-defined investment universe that we've been focusing on for our entire careers, and we think allows us to really understand the independent underlying forces that are driving company performance and share prices. At the portfolio level, we employ a top-down risk overlay that helps determine if there are any underlying themes or biases that have been created as a result of our bottom-up portfolio construction process. It's an extensive list and we're always refining it, but it would include things like shareholder base, balance sheet leverage, short interest, etc. We really want to make sure that we isolate and understand any of the inherent risks that we're taking that were unintended. From an organizational perspective, we think we've developed a strong culture of compliance that starts right from the top of the organization. We've got a highly experienced Chief Compliance Officer and Chief Operating Officer, a clear separation of operations and investment functions. We use an independent third-party administrator, multiple prime brokers, and we only deal with industry-recognized, well-regarded service providers.
What we believe makes us unique is the sandbox in which we invest, which is primarily Canadian non-resource mid-cap equities. Our experience as short sellers, particularly in the Canadian equity market, our investment temperament, and our alignment. While we have had success investing in the US equity market, our preferred sandbox is the Canadian mid-capitalization non-resource universe. These companies, by virtue of dynamics in Canada, tend to have very strong competitive advantages with very high returns on capital. From a capital markets perspective, Canada is dominated by a handful of very large institutional investors that do not have an ability to invest in this universe, leaving these very high quality companies underfollowed and undercovered by the brokerage community. We believe that investing in these companies provide very strong opportunities for capital appreciation over time. An important differentiator is short selling. Jeff and I have significant experience as short sellers in the Canadian equity market. At our previous firm, we were amongst the largest short sellers of individual securities in the country. By virtue of the fact that there are very few short sellers in Canada, there's a tremendous opportunity to generate alpha from our short investment portfolio. In terms of temperament, Jeff and I do significant amounts of equity research when we make underlying investment decisions, and that research allows us to have significant conviction in our underlying investments and gives us the opportunity to take advantage of market volatility when it exists to the benefit of long-term returns. In terms of alignment, Jeff and I have effectively 100% of our liquid net worth invested in these strategies at the same fees as our underlying investors, locked up for an extended period of time.
The portfolio of the average individual and small to mid-sized institutional investor in Canada has typically been allocated approximately 60% to equities and 40% to fixed income. This balanced portfolio has been a very simple yet effective asset mix over the past 3 decades. 60-40 is often marketed as a diversified portfolio, but 90% of the volatility has come from the stock side, and the bond side has really been a one-way bet on interest rates. In fact, since 1981, interest rates have been in secular decline, and this has really fueled excellent returns for very traditional portfolios. However, at the present time, the consensus among large institutional investors and global consulting firms is that investors should prepare for potentially lower returns over the next decade, and along with that, higher levels of volatility and potentially higher peak-to-trough portfolio losses. It is for these reasons that at this time we recommend investors look for alternative investments as a way to further diversify their traditional investment portfolios.
For each business we launch, we seek to achieve exceptional risk-adjusted returns. We do that by exploiting market discontinuities, by attracting exceptional talent, and by building industry-leading platforms. Before launching Alignvest Capital Management, our public market hedge fund, we conducted a comprehensive global search for the top long-short managers focused on the Canadian market. Reno and Jeff, our co-portfolio managers, are truly world-class investors. Our hedge fund benefits from being part of Alignvest Management Corporation, a large, well-capitalized, established firm. We provide our investors with world-class institutional quality infrastructure. We work with Tier 1 service providers, and we provide our clients with the gold standard of governance and oversight.
Alignvest is a unique alternative asset management firm. It is unique across two dimensions, two very important dimensions. One around its capital base, and two is around the people that have been attracted to this firm. Fundamentally, we created Alignvest because we wanted to solve the misalignment problem between those who manage capital and those who invest that capital. And really after the financial crisis, this problem was laid extremely bare in that what we saw was a perversion of incentives between managers of capital and those who invest. And what we wanted to do was something fundamentally different, something that our core would reflect massive alignment. And so what we did as partners at Alignvest was take almost $300 million of our own money and put it into a long-term, fully recyclable, fully discretionary fund. So why does that matter? Why is that important? Why is that so unique? Well, there are three reasons. First of all, it makes sure that we are completely aligned with our investors. It doesn't mean that we're not going to lose money, but it means that we are going to feel the pain alongside our investors. It also means that we're going to benefit directly alongside our investors. We're much more concerned about our performance than we are about management fees. And so in our fund ACMI, we are by far the largest investors as partners in the fund. The second thing it does is it allows us to think long term. We're not focused on this week or this month. We're focused about building businesses that are sustainable and that over time generate strong risk-adjusted returns. Our capital base allows us to do that. The third thing it does is it's allowed us to attract really strong people, people at the top of their field, people who are extremely strong at what they do, love what they do, and want to join us because what we provide them is an entrepreneurial opportunity to build a business with the permanence and stability of a capital base that is locked up for a long period of time.
Our equity long-short solutions aim to provide our investors with access to a proven portfolio management team that has a career history of delivering robust returns for our investors, but with significantly less volatility than broad equity markets. Within a portfolio setting, our funds have the potential to reduce volatility, improve risk-adjusted returns, and potentially reduce peak-to-trough portfolio drawdowns. The funds are also agnostic to interest rates, which means that they have the ability to profit from both rising and falling interest rate environments, and we think this is very significant going forward. Lastly, we're looking to attract investors who want to participate in the robust return potential of equities, but want to do so with significantly less volatility than they've been used to in traditional investment vehicles.